Massachusetts Senator Elizabeth Warren today outlined an updated version of the Glass-Steagall Act, which is designed to reduce risk at the nation's largest banks. She was the keynote speaker at an event hosted by the Roosevelt Institute and Americans for Tax Reform. This is 25 Minutes.
Thanks for everyone's patience this morning with the not long breakless period and for reassembling now. It's a huge pleasure and an honor to have Senator Warren joining us as our final speaker. I'll be very brief because she really truly does not need any introduction and to leave time for her remarks. Let me just say that Senator Warren's leadership was at the heart of the creation of the Consumer Financial Protection Bureau, which was a signal accomplishment of financial reform so far. And her continuing focus on holding Wall Street and Wall Street's regulators accountable to working families gets to the heart of the task ahead as well, and to many of the issues that people described in their remarks today. The financial crisis and the economic crisis that followed have made it sadly obvious in many people's lived experience that the rules and design of the financial system may look obscure, complicated, off to one side, but they, in fact, have enormous consequences for all of us. And what Senator Warren does so remarkably well is her clarity in penetrating that obscurity, and her tenacity in fighting for Main Street makes it much easier to be hopeful that together we can actually do something about a number of the things people talked about today and change that system for the better. So thanks so much for talking with us today, Senator.
Thank you. So thank you. It is good to be here with a group of people who still want to talk about financial reform. It's something important, something we still need to talk about, so I'm delighted to be here. I am also delighted to look out and see so many good friends, so many people with whom we fought shoulder to shoulder throughout the Dodd-Frank efforts, and after that in the regulatory efforts, and continue that battle today. So I want to start this by saying a very big thank you to Americans for Financial Reform and to the Roosevelt Institute for inviting me to speak here today. I've been working very closely with AFR and with Roosevelt, and I am delighted to be here. You know, it has been 5 years since the financial crisis, but we all remember its darkest days. Credit dried up, the stock market crashed, historic institutions like Lehman Brothers and Merrill Lynch were wiped out. There were legitimate fears that our economy was tumbling over a cliff and we were heading into another Great Depression. We averted that grim outcome, but the damage was staggering. A recent report by the Federal Reserve of Dallas estimated that the financial crisis cost us upwards, are you ready? Cost us upwards of $14 trillion. That's trillion with a T. That's $120,000 for every American household. More than 2 years of worth of income for the average family. Billions of dollars in retirement savings disappeared. Millions of workers lost their job and their sense of financial security. Entire communities were devastated. And a new Census Bureau study shows that, just a couple of months ago came out showing that homeownership rates for families with young children have declined by 15%. The crash of 2008 changed lives forever. In April 2011, after a 2-year bipartisan inquiry, the Senate's Permanent Subcommittee on Investigations released a 635-page report that identified the primary factors that led to the crisis. The list included high-risk mortgage lending, inaccurate credit ratings, exotic financial products, and, to top it all off, the repeated failure of regulators to stop the madness. As Senator Tom Coburn, the subcommittee's ranking member, said, Blame for this mess lies everywhere from federal regulators who cast a blind eye, Wall Street bankers who let greed run wild, and members of Congress who failed to provide oversight. Even Jamie Dimon, the CEO of J.P. Morgan Chase, has emphasized that inadequate regulation was a source of the crisis. He wrote this to his shareholders: "Had there been stronger standards in the mortgage markets, one huge cause of the recent crisis might have been avoided." The crash happened quickly and dramatically, and it caught our nation and apparently even our regulators by surprise. But don't let that fool you. The causes of the crisis were years in the making, and the warning signs were everywhere. As many of you know, I spent my career studying the growing economic pressures on middle-class families, families that worked hard and played by the rules and still can't get ahead. And I've also studied the financial services industry and how it's developed over time. A generation ago, the price of financial services, credit cards, checking accounts, mortgages, signature loans, was pretty easy to see. Both borrowers and lenders understood the basic terms of the deal. But by the time the financial crisis hit, a different form of pricing had emerged. Lenders began to use low advertised prices on the front end to entice their customers in, and then made their real money with fees and charges and penalties and repricing back in the fine print. Buyers became less and less able to evaluate the risks of a financial product. Comparison shopping became almost impossible, and the market became less efficient. Credit card companies took the lead, with their contracts ballooning from a page and a half back in 1980 to more than 30 pages by the beginning of the 2000s, and teaser rate credit cards that advertised these deceptively low interest rates paved the way for teaser rate mortgages. Now, when I worked to set up the Consumer Financial Protection Bureau, I pushed hard for steps that would increase transparency in the marketplace. The crisis began one lousy mortgage at a time, and there's a lot we must do to make sure there are never again so many lousy mortgages. The CFPB made some important steps in the right direction, and I think we're a lot safer now than we were then. But what about the other causes of the crisis? There's no question that Dodd-Frank was a strong bill, the strongest in 3 generations. I didn't have a chance to vote for it because I wasn't in the Senate yet, but if I'd had the chance, I would have voted for it twice. I would have. But the law is not perfect, and so it's important to ask, where are we now, 5 years after the crisis hit and 3 years after Dodd-Frank? Now, I know there's been a lot of discussion today about a variety of issues, but I want to focus on one in particular. Where are we now on too big to fail? Where are we on making sure that the behemoth institutions on Wall Street can't bring down the economy with a wild gamble? Where are we on ending a system that lets investors and CEOs scoop up all the profits in good times and then stick the taxpayer with the losses when things go wrong? You know, after the crisis, there was a lot of discussion about how too big to fail distorted the marketplace, creating lower borrowing costs for the largest institutions and a competitive disadvantage for the smaller ones. There was a lot of talk about moral hazard and the dangers of big banks getting a free, unwritten, government-guaranteed insurance policy. Sure, there was talk, but look what happened. Today, the 4 biggest banks are 30% larger than they were just 5 years ago. And the 5 largest banks hold more than half of all the total banking assets in the country. One study earlier this year showed that the too big to fail status is giving the 10 biggest U.S. banks an annual taxpayer subsidy of $83 billion. Wow. Who would have thought 5 years after the crisis that we witnessed firsthand the dangers of an overly concentrated financial system, that the too big to fail problem would only have gotten worse. Now, there are many who say, sure, too big to fail isn't over yet, but Congress should wait to act further until the agencies have had a chance to issue a lot of the Dodd-Frank required regulations. And it's true. There are still rules left to be written, and that's because the agencies have missed more than 60% of their statutory deadlines. Now, I don't understand this logic. Since when does Congress set deadlines, which regulators then miss most of them, and then take that failure as a reason not to act? I thought that if the regulators failed, it was time for Congress to step in. That's what oversight means, and that's certainly a principle that would have saved our country during the financial crisis. So let's put the pieces together. Think of these two things. It has been 3 years since Dodd-Frank was passed, and the biggest banks are bigger than ever. The risk to the system has grown, and the market distortions have continued. And second, while the consumer agency has met every single statutory deadline, so we know it's possible to get the job done, the other regulators have missed their deadlines and not given us much reason for confidence. The result is that the too big to fail problem remains. Now, I add that up, and it's clear to me. I think it's time to act. The last thing we should do is wait for another crisis, for another London whale or another LIBOR disgrace or another robo-signing scandal before we take action. For that reason, I partnered with Senators John McCain, Maria Cantwell, and Angus King to offer one potential way to address the too big to fail problem, the 21st Century Glass-Steagall Act. By separating traditional depository institutions from the riskier financial institutions, the 1933 version of Glass-Steagall laid the groundwork for half a century of financial stability. But throughout the 1980s and 1990s, Congress and the regulators chipped away at Glass-Steagall's protection, encouraging the growth of the mega banks and a sharp increase in systemic risk. They finally finished that task with the 1999 passage of Gramm-Leach-Bliley, which eliminated Glass-Steagall's protections altogether. So the 21st Century Glass-Steagall Act would reinstate many of the protections found in the original Glass-Steagall Act. It would wall off depository institutions from riskier activities like investment banking, swaps dealing, and private equity activities. It would force some of the biggest financial institutions to break apart and eliminate their ability to rely on federally insured deposits as a backstop for their high-risk activities. In other words, a new Glass-Steagall Act would attack both the too big and too fail. It would reduce the failures of the big banks by making banking boring, by protecting deposits and providing stability to the system even in bad times. And it would reduce too big by dismantling the behemoths so that big banks would still be big, but not too big to fail, or for that matter, too big to manage, too big to regulate, too big for trial, or too big for jail. Big banks would once again have an understandable balance sheet, and with that would come greater market discipline. Sure, the lobbyists for Wall Street say that the sky will fall if they can't use deposits in checking accounts to fund their high-risk activities. But they said that in the 1930s, too. And they were wrong then, and they are wrong now. The Glass-Steagall Act would restore the stability of the financial system that began to disappear in the 1980s and 1990s. Now, this is one way to deal with too big to fail, and I think it would work. And I am very grateful to AFR's continued push to make it a reality. But there are other approaches, too. So what I want to know is this: How much longer should Congress wait for the regulators to fix this problem? Another 3 months? Another 3 years? Or until the big banks crash the economy again? Treasury Secretary Jack Lew recently said that if too big to fail is still a problem at the end of the year, it might be time to consider other options. Anyone counted how close we're getting to the end of the year? Now, I applaud Secretary Lew for laying out a timeline, and I'd like to see the other administration officials and regulators follow suit. If Dodd-Frank gives the regulators the tools to end too big to fail, great. End too big to fail. But if the regulators won't end too big to fail, then Congress must act to protect our economy and prevent future crises. We should not accept the financial system that allows biggest banks to emerge from a crisis in record-setting shape while working Americans continue to struggle. And we should not accept a regulatory system that is so besieged by lobbyists for the big banks that it takes years to deliver rules, and then the rules that are delivered are often watered down and ineffective. What we need is a system that puts an end to the boom and bust cycle, a system that recognizes we don't grow this country from the financial sector, we grow this country from the middle class. Powerful interests will fight to hang on to every benefit and every subsidy they now enjoy. Even after exploiting consumers, larding their books with excessive risks and making bad bets that brought down the economy and forced taxpayer bailouts, the big Wall Street banks are not chastened. They have fought to delay and hamstring the implementation of financial reform, and they will continue to fight every inch of the way. That's the battlefield. That's what we're up against. But David beat Goliath with the establishment of the CFPB, and just a few months ago with the confirmation of Rich Cordry. David beat Goliath with the passage of Dodd-Frank. We did that together. Americans for Financial Reform, the Roosevelt Institute, and so many of you in this room. I am confident that David can beat Goliath on too big to fail. We just have to pick up the slingshot again. It's good to see all of you here. Thank you. Thank you. Thank you. Thank you. Thank you. Thank you, dear.
Moment to...
Sure. Let me just make sure. I never own my own schedule. Anyone want to do questions for just a minute? Is that okay? Broad's holding up 2 fingers, which I think means 2 questions. Okay.
Thank you so much, Sandra. So there's a microphone on the side, and if people could introduce themselves and ask their question briefly, that would be wonderful.
Okay. Thanks, Lisa.
Hi, I'm Alexis Goldstein with the other 98%, and I was hoping you could talk about the part of your Glass-Steagall bill that takes away the derivative seniority during bankruptcy, which I think is really important. I'm sure you agree, but I was hoping you might be able to elaborate a little bit on why you put that in there.
So the reason that is in there, as some of our bankruptcy experts in the room know, is that, in effect, what the current provision does in the bankruptcy laws is that it permits a certain group of creditors just to opt out, to get a first priority if one of the financial institutions collapses. And let's be clear, I want everybody to follow what this means. This means that they don't have to have any market discipline. They don't have to watch to see whether or not, when they're lending to one of the giants, whether or not that giant is in good financial shape, what the balance sheet really says about the risks they've taken on and how they're making their profits. It's another form of too big to fail. And I just want to be clear here. It's not something that exists with the small financial institutions. And that's why this is so fundamentally wrong. We perpetuate too big to fail, which puts the taxpayers at risk. But what it also does is put every financial institution that's not in that category at a competitive disadvantage. Nobody lends money to them. Nobody advances capital to them without a very careful scrutiny of whether or not they're going to be able to pay back. But the big guys are able to walk away for free, and that's wrong. Thank you. It's a good question.
I count myself among your biggest supporters, and thank you for everything you do.
Thank you.
I believe that there is still a law that prohibits any bank holding more than 10% of total deposits in the U.S. And I believe that the last few years, 3 or 4 biggest institutions have gone above, and that Congress has been granting them exceptions. Now, Americans differ in their beliefs, but most of us believe that this is the country of laws. And most of us don't like exceptions to obeying the law. How easy would it be to just stop that?
You know, it's a very good way to put it as you were saying it. You were saying, I thought you had a rule, and I was thinking, I don't think we do have such a rule anymore, because we have been creating this rolling exception to the rule, so no one actually has to follow the rule. But you're right, and what it's a reminder of is that too big to fail is a problem that stretches across our economy. It's all the way through the financial system, but it has implications throughout the economy. The ways to attack too big to fail are many. There's not a single magic bullet to this. There are lots of ways to go after it. I propose, along with John McCain and with our other co-sponsors, one way to do that, and I think it would help. But there are other ways we need to be thinking about as well. And the question on limitations on deposits and the proportion of deposits is just one more way to get at that problem. There was a policy reason for passing that law in the first place. And that is that Congress understood initially that too much concentration in the banking industry was bad for the economy, that it ran too much risk for the taxpayers, and that it was bad for competition in the banking industry. That's the kind of fundamental values we've got to get back to. We've got to get back to running this country for America's families, not for its largest financial institutions. Thank you. Thank you all. Thank you. Thanks, Lisa.